But I'm glad your son is doing golf, man. Is that his first thing or something else?
Really, we started off with soccer, as with most parents, and then I get a lot of people ask me like, "You gonna get him into football?" And I was like, "I don't really care
Sounds like
to
doing something.
to get him in football. Like, that's not really a passion of mine for my sons to play football."
Me neither.
But it was like, okay, cool. Like I say, if he's interested in golf and like something that's not so taxing on
Body.
the body, it was like I'm more inclined to get him involved with stuff like that.
Good for you. I'm so happy to hear that. I can't tell you how many times people say I'm going to be a professional football back. I cringe when I hear that, Larry. And that it's nothing personal, man. I'm just like, I don't know how many hundred seats are available for any team at any time or any league, right? How many? I don't know. Do you know 400, 500 seats?
Uh, I don't. I honestly don't know.
I don't even know.
Um, like I say, if he wants to play, like I mean, like I say, I'm not going to prohibit him from anything, but like I'm educate him on
Good.
what to expect. Um, but so it's like so I'm expose him to everything that he wants to be exposed to. If he wants to try something out, like let's go for it. But
Cool.
I'm not the one driving that boat. I
Good for you, man. Thank you for that. Thank you.
think his grandma does more than me.
He go take care of me now. You get no play that game, play that ball. All right, Roundup, what's going down? I am your host, your pilot today. I am Chris Haskins. My mission and ministry is to raise your financial literacy through real estate investing and entrepreneurship. In doing that, I have teamed up with Larry Pendleton, CPA here in Norfolk, Virginia. And the man knows 100% of this information regarding taxes, real estate, write offs, deductions, depreciation, all that stuff, entity structure. And today we want to just kind of share with you some 40,000 foot view of a 40,000 foot view of just Larry's thoughts on entities, on buying real estate, and just running your business in general. Ladies and gentlemen, Larry Pendleton, how you doing, brother?
Appreciate you, Chris. How's it going, bro?
Man, this is gorgeous. 75 degrees outside, humidity's low. I'm living in life.
Especially if you're going to those hot attics.
That's right. Yeah, you're right about that. So, Larry, we talked about this very briefly. Just give my roundup homies a little bit of your background, real quick, if they don't know who you are, and then we'll get into our meat for today.
Yeah, Larry Pendleton, CPA for real estate investors. I am the co-founder of PC Financial Services, where our mission is to help people achieve financial freedom through real estate investing and tax strategies. I've been doing tax consulting for over a decade and invested myself for over 6 years now, and
Wait,
I took over the past 3-4 years to combine those two worlds as opportunity to add value to others.
thank you, man. Yeah, we really appreciate you. I know your schedule is crazy, so thank you for your time.
I'm
So,
happy to be here.
what should we be thinking about? Let's talk about buying the property and then running the business because they're two totally different things. I'm gonna let you
Yeah,
take it, Larry, just for the thought process. Where will we even start?
yeah. It's a common question I get, but the main thing is to consider is like what type of business are you running? Are you a flipper? Are you a wholesaler? Are you renting properties, so forth and so forth? Because now we're talking about um, passive versus non-passive income or activities from that standpoint, and they're taxed differently depending on which route you take.
What's the
Um,
definition of passive versus? I heard you didn't say active. You said
yeah, so
non-passive.
yeah, there's passive and then there's active, which is active is interchangeable with non-passive. The proper term
Okay.
is non-passive. So I'll use interchangeably.
Oh Lord, you're getting too high level.
Along,
I got to bring you down a little bit, Larry. I got to bring you down with that guy. We don't know, Larry.
uh,
I'm working for y'all roundup. I'm trying to extract information out of Larry, so I know he's high level. We got to bring him down to our level. All right, Larry. Passive,
no,
active,
I appreciate bringing me down a bit. So, um,
non-passive. It's like, are you married or not unmarried? I'm like, what the hell? Is that divorce? Is it separate? I don't even know. Go ahead.
that's a whole other chapter.
Uh,
So when we talk about so being a passive, like running a passive business, or being a passive investor, you're talking about more of the IRS deems, like say, if you're just lending money to a deal, if you're just receiving interest or dividends from a business that you're not really actively involved in. Ironically enough, the IRS deems rental real estate, like that business, is per se passive.
Mm-hmm.
Even though for those who have rental properties know there's nothing passive about that business. But the IRS sees a lot of times people buy a property, throw a property manager involved in it. Like, are they really like involved on a day-to-day basis with it, or they just got somebody managing that business? So that's why it kind of falls into that to that passive realm. Um, and,
Gotcha.
and then once we start talking about active, and now where it's like, okay, you're actively involved flipping that property or running your wholesale business, even though you may have people working for you, you can actually prove that you're more actively involved, or materially participating is the proper IRS term. But for this sake,
Material.
we'll just say active involvement with the day-to-day operations of the business.
Gotcha.
Um, to prove that. And why those worlds are different is because, yes, you're taxed based on whatever your effective tax rate is, but on the active side, similar to your W-2 job, you're subject to self-employment taxes or FICA,
Mm.
basically Social Security and Medicare. So that extra 15.3% on top of what you're already taxed there. And of course,
Mm.
as an employee, you're splitting that 50-50 with your employer. But as a business owner or being self-employed, you're responsible for that whole 15.3% based off of your net income, or or whatever salary that you're paying yourself. So that's
Mm-hmm.
why we want to understand like which side, what type of business that you're running, because that will determine um, how you're taxed, and then the proper tax strategies or the type in the structure you should be talking to your attorney as well as your tax advisor, in order to mitigate your liability first and foremost, as well as your tax liability.
My mentor told me, Chris, it is your obligation to pay as minimum taxes as you can every year. What would you say to that, Larry?
It's factual because you have to consider that as a business owner, as a property investor, is that the tax law itself is made for big business owners and investors,
Mm-hmm.
primarily because you're producing for the country as a whole. You're providing housing, you're providing jobs, food, water, so such and such, such and such. So like you're just not, yes, you're making money, but like you're just not making money and it's only really benefiting you or benefiting your employer. So
Mm-hmm.
once you start getting to the larger scale type of investing, then okay, the IRS puts all these stipulations, all these incentives, I should say, in the tax code, because really what they say, less than 1% of the tax code is about actually paying taxes. The reason why it's so robust because it has all these credits, deductions, exemptions, amendments, and all that from there. But the clear basis, like if you make money, you're going to be taxed on it. But if you're operating a certain way, the books open up for you a bit more to claim more deductions.
Mm-hmm. It's so crazy. I never forget Robert Kiyosaki saying years ago, you can make money one way and it's taxed at a certain number, and then you can make that same money a whole nother way and it's taxed at a different number. It's just amazing to me, Larry.
Yeah. Like I said, I've seen situations, and mostly we talking about like the percentage of your income. I
Mm-hmm.
have seen people make seven figures, but only pay 10% of that as taxes, and I've
Mm-hmm.
seen people who like only make five figures, and they're in the 20% of their income is taxed, if
Mm.
not more. And that's just truly how. Once again, as we said in previous recordings, it's not a right or wrong, good or bad. That's just how the system is built,
Mm-hmm.
for the purposes of the government wanting to circulate more money into the economy by encouraging people to be large business owners and investors.
Sweet. So, do we want to attack how to take title first or how to do the business? Which one would you want to go to?
Now, if we're going, we can go to the whole. Let's just kind of start with the business aspect of it. So
Okay, the
now,
business how we all right.
so now, if we're talking about now, as I tell people, everyone talks about open up LLC. Like, do I have to be an LLC to get the deductions? Do I? And the most blunt way I can tell people is that having a LLC does not determine like what you can write off.
Mm-hmm.
That really doesn't mean anything. I have a pin here. Like I can buy it under PC Financial Services, or I can buy it under Larry Pendleton, just my name. It's still a business expense for me because I'm operating that way. So people shouldn't get so caught up on do they need an LLC for the tax deductions. You really should be asking do you, what type of entity um, is going to provide the best asset protection for you. And you'll talk to your attorneys and whatnot. And Chris, I know you're really big on trust. And people just need to determine, okay, are you doing revocable trust or irrevocable trust? You need to kind of know the proper thing with that. Your trust could own your LLC.
Yes.
If
Yes.
you're going to start to layer your protection.
Larry.
And this is, I guess I should throw a disclaimer that I'm not an attorney. This is
Well,
something
yeah, this informational purposes only, y'all. Information. But Larry, let me rewind a little bit about this entity thing. I see a lot of my mentor calls it playing business. I see a lot of
Mhm.
people uh, taking an incredible amount of time to determine what structure should they have: S-Corp, C-Corp, INC, LLC, all that stuff, and then they ain't even make no money yet. So, can we preface this conversation by maybe? Let me ask you: should they be focusing on how the hell they're going to do business before they even worry about a structure, or should they be dealing with all this structure stuff and then figure out how they're going to make money?
Most likely the former. Like, let's figure out how you're going to make money first, determining that aspect of it. Because if you're going to get into the buying, holding rental properties, okay, you could stress a lot of time about having an LLC in place, but and if it's for the purpose of asset protection, what asset are
You ain't got
you
nothing.
protecting
You ain't got
at that
nothing to protect. You ain't got nothing
point?
to protect.
And then if you're trying to get a loan with a bank, you can have a perfectly set up LLC and the bank is like, you have no history of this business operating, so
Wow.
you're like, they're still going to go off of your personal name. You're still got to be a personal guarantor
Mm-hmm.
on that loan. So it's like I said, it's not so much getting bogged down into the entity, because a lot of stuff can always be transferred over, deeded over to an entity that's going to do provide the asset protection that you're looking for.
So I just want to preface this whole training here today. Think how you're gonna make money. And I know Larry just said this. Think how you're gonna make. How the hell are you gonna get some money coming in? Right? Because Larry, I coach and train, and I want to ask you. You have deal with a lot of tax guys. I just see so many people getting caught up on this entity thing, Larry, and I'm like, well, have you made any money yet? Well, no.
Well, there's a book I read about was it Bigger Pockets, like Brandon Turner.
Mm-hmm.
I forgot the name of the book, but I'm paraphrasing here. And but the premise of it that people use the aspect of setting up their entity or setting up their LLC really more as a fear of actually running the business. Like
Ah,
it's
the
like
fear.
instead of actively figuring out how you're going to make money, like they're so caught up in I gotta have an LLC in place, and it's like, okay, once again, what are you protecting if you don't have anything? What are you really putting at risk if you just got a whole bunch of offers? Like if you're not going out there putting out offers, and you're more so worried about the operating agreement and the EIN number and business name and all of that, where um, people do benefit people that they know, like, and trust, no matter what the name of the business is at that
Don't
point.
matter. Well, I'm gonna be transparent, Larry. I ran my business for several years back in 2004 with no EIN, like nothing. I was just because at the time I was flipping contracts. I had learned how to wholesale back in '04. I have no nothing, man. I just was getting checks made. I'm doing contracts in my personal name, flipping contracts. Nobody cared.
Yeah, I mean, I've bought properties, or like I said, I've been personally guaranteed on those. We didn't have like it was really no purpose of getting an entity in place because um, the lending, like I say, it didn't really matter for whether the lender, and then we end up getting deed everything over, or we refinance,
Mm-hmm.
and then we'll put it in the business name at that point because now we got something to be liable for. Now
Got
I know
sweet.
people are getting into the hard money loans for their flips, and most hard money lenders they do
Yeah,
require
they do
to
that.
have entity. So if you're going down that path, okay, like but that's you have already determined how you're going to make your money. You decide that you're going to flip properties.
Yep.
Um, then you want to get that stuff like you have already set a path for yourself, and part of that path and how to get the funding for it if you're going down that path is to get an LLC in place. You didn't worry about getting an LLC and then worry about um, if you're going to do flips or rentals at that point.
Good. Okay. I didn't want to go too far on that. I just want everybody to understand. Don't get paralyzed by all this stuff we're talking about, especially Larry. We need you to focus on getting a check. Okay. All right. Keep going, Larry. Sorry.
No, I mean it's all good. So I mean at that point, so if let's just hypothetically say we have um, a flipper and a duplex owner. So we got two separate businesses. Both of them decide to go get an LLC to put the properties under at that point. And to your point earlier, the person who made, let's just say, $20,000 on the flip is going to be taxed differently from the person who made $20,000 on the rental income
Mm,
because they have that additional 15.3% self-employment tax they have to deal with their business. As a prime example I like to tell people is that if you make $100,000 on the flip, like you netted $100,000, your tax bill is going to be at least $15,000 off the break. If you had nothing else to deduct against it, because you got to deal with that, like, and your children, your like you could offset that and the standard deduction and what you're itemizing, like those don't really play a factor. So you may be some credit to help offset that, but if you're just a single individual, you flip a house, real nice flip, $100,000, your minimum tax bill is going to
gotcha.
be it's going to be 100,000. It's going to be $15,000 there. So
That's
like I
just
said,
the start, though. I mean, that's
that's the start. And even if you have a revocable living trust or a land trust, um, same thing with the LLC, where it's like those are just another entity to protect your name. Now, if you have a revocable living trust or land trust, like I said, will be interchangeable with those as well, because people hear different terms from. All that information is still reported on your personal tax return. It's just a stronger level of protecting your name than the LLC. I mean, I know a lot of people on this watching this recording, watching this live. Y'all deal with skip tracers all the time. They can break an LLC down and find the owners like it's nothing. So the trust helps helps provide some additional shielding from that, but it has to be reported somewhere. The activity
hmm
has to be reported somewhere. So,
activity.
yeah, so no different than a single member LLC where it's just you. Your trust is doing the exact same thing. It's asset protection, but there's no tax saving opportunities.
Y'all
Uh,
hear that, right? I want
uh,
y'all to
uh,
get that.
with those.
Basically, Larry, are you saying that basically the trust, the land trust, or revocable grantor trust that we use are just pass through entities down to whatever is going to, whoever entity owns it?
Yeah,
Is that what
or
you're
the
saying?
best way is they're disregarded entities.
Disregarded entities.
So
Okay.
you're talking about single member LLCs, revocable living trusts, land trusts. Those are disregarded entities, meaning that they do not require a separate tax filing.
All right, y'all.
All the activities reported on your personal tax return. Now, if you get into partnerships or you're doing irrevocable trusts, now those, or you get into S-Corps or corporations, no, those entities do require a separate entity. Now, those are then now not irrevocable trusts. So now your S-Corps and your partnerships, those are your pass-through entities because those entities don't pay taxes. They pass through. You'll get a K1, you'll report that on your personal tax return.
Gotcha. All right, let me reintroduce you. Roundup, if you're just joining us here, we're hanging out with Larry Pendleton, CPA. We're just going over a little bit of entity structure. Now, this is by no way the end of the conversation that you need to be having when you're after you're making money. Don't be trying to figure all this stuff out before you make any money. Start making some money. Start doing some wholesalings or buy something. Start doing something, and then think about your entity structure. Because I don't want you to get caught up in trying to figure this stuff out and scaring you from not making no money. All right. So if anybody wants to get in touch with Larry, I keep forgetting it. Larry, I need to put this in the video description, brother. Give me your how to get in touch with you.
Yeah, so let me drop my link. They got their phones. They got a lovely QR code over my
You can scan the screen with that.
You can scan the screen with that.
Let me put you up by yourself so y'all. There he is, y'all.
And then,
Did you have something you were gonna share on the screen too, Larry?
I was wondering if it was going to make sense to. How do I leave a comment?
You talking about based on the presentation? I mean, based on what we're going over today?
So I'm drop my link to the chat as well.
If you put it in the chat, I can copy it. Or
Yeah.
Roundup, get your questions in for Larry too. You put it in the private chat or the regular chat?
I think I put it in the private chat.
I don't see it there. Oh yeah, there it is. I got it. That's your thing. Okay, copy. I'm gonna put this in the comments, and I'm gonna put it in the show notes too. That's how y'all book an appointment with Larry if you want to. I'm glad you squared that up with land trusts. I just feel like trusts are so mysterious to people, and it's nothing but black ink on white paper.
Yeah, I mean it's. And do you see my whiteboard?
Yeah, hit it, brother.
So
we technified up in here, technological.
Trying to be fancy. Trying to. So basically, what we're trying to get at is. I am not an English teacher. I am.
Just abbreviate, bro. Just abbreviate.
So this kind of recap. So people hear about all these type of entity structures. So and now let's put tax. So to kind of recap, the tax benefit of having any of these set up, there is none. I mean, that's really all it is. Is really more so is your asset protection.
Gotcha.
Now, let me go back because now your S-Corp potentially.
Yeah, I was going to ask you about that because I got a salary now.
Yeah. Now your S-Corp potentially, and X that too quickly. So your S-Corp potentially. So this is really more so for your flips and your wholesale. And I'm gonna give all credit to tax attorney Mark Kohler for this chart here.
Mm-hmm.
I cannot say I claim this, but it makes so much sense because everything eventually kind of reports on your so your W-2, you may get some 1099s, all of that. But if you're running a business, and then this is the two worlds I was talking about earlier. You're either running a business actively, or you got investment activity. So you may have your so you got your rentals, you may be a lender.
My favorite.
May even be a a limited partner for equity.
Mm. That's
So
still passive, right?
that's still passive because you're not actively involved
Mm-hmm.
in the management of that business.
Yeah.
So all of these are still going to report on into your 1040 eventually. They're just going to be different forms that you're receiving. So you may receive a 1099 INT for your lending. All your rentals are going to be reported on your Schedule E. So is your equity position on your deals here. Now with your business, now you could be flipping. You could be a wholesaler. I'm just going to do WS. From there, you could be running a tax business. Who knows? I'm not sure who else you got watching, but
Internet marketer. Put that on it. How about
yeah.
internet?
So yeah, let's do internet from there. So, but this is all going to be like hit with that additional 15.3% self-employment tax. So that shows up here, but it doesn't show up on the investment side of things.
Sweet.
So that's why these can make the same amount of income, but these going to be taxed harshly from that there. Now the question is, how do we mitigate the 15.3% or 15.3% based off of your any structure? Now, if you're just an LLC or you got a land trust that you're buying all your flips under, you're not going to get anything. This is where the S-Corp comes into place.
Mm-hmm.
So we kind of go break it down from here. So the S-Corp is still a pass-through entity. So it doesn't pay taxes. It all reports down to you. Now, as an S-Corp, now when you're an LLC, as an LLC or as a land trust, as I tell people, it's almost as if you are it and it is you. Which basically means that any money that you're taking out the business are just equity distributions out the company. So you can't pay yourself a salary. You're really are just kind of almost an ATM. If you're pulling money out, it's almost as if you're using an ATM from there. So and also whatever you pay yourself isn't a expense to your business. So people like to try to get that written off. It's like if you're just an LLC, you're not going to be able to get that benefit.
Mm-hmm.
As an S corp, you are required to pay yourself a W-2, or in other words, a reasonable salary. The reason why is that you're now separating yourself from the business. You have now become a true employee of the business itself. So the IRS requires everyone to be contributing active income into the self-employment bucket, or into the FICA bucket. And if you're saying that you're now an employee, and you're no longer going to be taxed at your net income at the 15.3, then your W-2 absorbs that. So what does that all mean? So kind of back to our flipping example, at that 100K, as just an LLC, your minimum tax bill is going to be at least 15K.
I think we got to be clear though, Larry. It ain't from my flips. It ain't nowhere close to 15K. I just want people to know that's just the start.
That's this is just the start. And the reason why I say at least, and let me.
But you talking about some masters if they're only paying 15K on that 100. I mean, you got some real
Well, I'm not saying in masters if they are. I'm just saying at least 15K, because that's going to be the self-employment tax part.
Okay.
Now there's still going to be what's called your marginal taxes. So basically, any of the income that you make, including the net income from your business. So you may be, let's just say your effective tax rate is 20%. you still got to pay 20% on that 100,000, separate from the 15% that you pay for the self-employment tax on that.
That's federal.
Haven't even gotten to the state part of it. We probably wouldn't go down that path from it there. So, and this is all, and this is, like I said, make sure that we're specifying. This is net. We are not.
That's so nasty.
We are not taxed on our gross. We are taxed on our net. And the reason why I want to emphasize that is because I have people who come from other tax advisors or tax preparers, and they get the 1099 from the bank, or they sold the property for $500,000, and that's what's put into their taxes as the income from the business. It's like you didn't make 500. That was, you sold it for. But you had expenses, you bought it for a certain amount. Like, your net is different. We're taxed on our net. We're not taxed on our gross.
Larry, let me stay here for a minute because I bought my city, my Hampton, Virginia. That's one of the reasons I'm getting out of here. They do require us or investors to pay tax on the gross receipts, what they call it. We went back and forth with them, with several of us tried to fight it, man. But they're charging us for our business license. Gross receipts, dog. It's truly amazing. You can sell a house for $500,000 and only make $40,000. You, according to the city, man, you have to pay gross receipts. It's insane.
Yeah, like I say, it goes like city by city, state by state, county by county. Like, you have to be somewhat aware of the requirements that wherever you're living at or doing business at is going to be taxing you from there.
It's insane. Well, you got a business like you in Norfolk? Do they do gross receipts out there too?
Yeah, they do gross as well, depending on the type of service that you're providing or type of business that you're running.
It's crazy, man. I'm sorry.
No, it's like it's all valid, because, like I said, we're just talking about federal. I said, once we start getting into states and cities, like I say, that's why so many people are looking to move out of states like California and New York. Though they may love living there, it's the politics and the taxes that ends up driving some people away.
They're keeping you broke. You broke. Okay, sorry about that.
No, like I said, it's all valid stuff. So really at this point, like I say, we got the 100K net. Like I say, with just LLC, that's your minimum tax bill. As an S-Corp, let's just say you decide 30% is a reasonable salary. So now you're only taxed at the 30K now for your self-employment tax.
Sweet.
And that's,
man.
So that tax, off the top of my head, is roughly 4,600. My math may be off a bit.
15, 30. That's fine, man.
Yeah. So 15. roughly 4,600. I'll bring out the calculator next time. But just making that election from an LLC and into an S-Corp can save you nearly $10,000 in taxes. Now, it's also important to specify that, like, we're saying LLC tax as an S-Corp. I'm not recommending people to just start a corporation. There's a lot more legal documents that are required for it. It does require a separate tax return to be a corporation, or to be elected to be taxed a corporation. And most startups, or most people who are kind of just getting started, like, it doesn't really make sense to be an S-Corp.
Why not?
Because there's the associated costs. So, like, for me to do a S-Corp tax return, the base fee starts off at $2,000. I know there's tax advisors that charge more. There are some that charge less. But if the tax savings from doing the S-Corp election does not exceed the cost of what your preparer or your advisor is charging you to file for that separate tax return, and how you're going to pay for doing your like getting your payroll done. Like, are you going to do your own payroll, or are you going to pay somebody else to do it? It's either going to be your time or your money that's going to be involved with it. So you have to really know all of the intricacies of what's that cost going to be, and are those tax savings good enough to make that jump. Like for me, unless your net is at least 50K, it's not worth even having the discussion.
Is that the baseline that you kind of look at this thing with, Larry?
That's my baseline. And unless your business is netting $50,000 consistently, like year after year, like it's not going to make sense. Because whether it's me or whoever, like I said, you have to file a whole separate tax return, and that's a whole nother fee.
One of the deadline.
A whole nother deadline. Now we're not talking about April 15th. That's got to be done by March 15th. Who's doing your payroll? Who's doing the quarterly reports, the 940s and the 941s for your the quarterly and the annual reports for your payroll, and getting all that done, making sure you got the right allocations, the proper, like determining what a reasonable salary for yourself from there. Like unless your business is consistently doing that, you could be wasting money trying to save on this 15.3. Which is why part of what my consulting is, and what I tell people is like, don't let the tax tail wag the investment or the financial decision dog. Like it has to financially make sense for you. It has to be a solid investment. If not, the tax stuff should not drive that, because you'll end up spending more money and like end up paying probably as much to all of those other services and not to the government. Now, like I said, for me, that's great. Like, if you want to pay me extra money, that's fine. But I want to make sure that it's valuable. And whoever you're working with, whoever your tax advisor is, need to be knowing your situation and knowing what's benefiting you overall, not just not paying the government. Because you can not pay the government and pay someone else the exact same amount for that service.
That's crazy. That S-Corp thing, man. I a couple years back, I switched over, so I kind of understand a little bit about it, but it does cost more. So at the end of the day, 50 grand net, which is, I mean, all of us should be striving to make more than 50 a year. However, some of us are starting. So just keep that in mind when you're coming through. Larry, we've been on here 40 minutes, man. Let me get some questions. Good gracious. You can keep going. Brandon Yang says, is it an LLC only for liability purposes, Larry?
Yes. Oh, yes. So basically, that's the main thing, is when you get into these LLCs, you're primarily is trying to asset protection purposes, liability, so forth there. But I also have people who get into just having just a strong insurance plan.
Both.
And then they may do both. They may have the insurance. Like I have clients in California who kind of go the insurance path, because it's $800 a year just to have an LLC in California.
Good Lord.
And what is it, $100, $150 here in Virginia a year to keep your LLC
good
registered.
Standing. Yeah.
So it's all this kind of based on, the main thing when it comes to LLCs is asset protection, and build from there.
Lucy, what if you're just planning to rent your personal home and you want to protect yourself? Good question.
A really good question. I mean, like I said, you have your homeowner's insurance. I'm assuming associated there. Like I said, most likely than not, you're not going to be able to move, depending on your lender, move your personal home into your LLC. Now you can move your personal home into a trust if you're trying to get some asset protection there. But like I say, it's like I say, it's more so like that's a stronger move. Like just understand all the costs and stipulations related to it.
Why can't I put my house in the LLC, Larry? Who cares? Even if the lender, I mean, why would they say they don't decide to call the loan, or they don't even find out about it? Why wouldn't that? Why does it matter?
Yeah, I mean, now if you're talking about just the deed over, then yes, kind of back to our sub two conversations a couple of weeks ago. Then yeah, you can go with the sub like that type of route, get it deeded
Oh,
over.
you were talking about like putting the loan over into the LLC. Yeah, that ain't
Yeah, I
happening.
guess I was more into
That
that
ain't
route, but
happening.
we're just talking about getting the property into an entity. Then yeah, you can just deed it over at that point.
But what you're saying, yeah, I agree with that wholeheartedly. I don't know. No lender's going to do. Well, I take that back. I don't know of a lender that's going to just loan an LLC money where you live in the property.
Yeah,
If you got one of those, man, y'all need to
you still have the
really,
personally guarantee on it, so
yeah, it don't matter. Brandon says, doesn't LLC make money transfers harder to do? I'm not quite understand that one. Money transfers. Mhm.
yeah, I need more information on.
It's just that you don't want to be a sole proprietorship, right? I don't know. Well, I got Larry. You want to answer that? I don't know.
I'm not sure from the money transfer perspective. Like I say, I mean, sole proprietors, single member LLCs are really the same. As I mentioned before, I can buy this pen as sole proprietor Larry Pillington, or I can buy it under PC Financials LLC. Tax wise, it's going to be the same. Now, so once we start getting into the liability and like how you want to protect yourself and protect your assets, yes, having an LLC over being a sole proprietor is better from that standpoint. I'm not sure about the money transfer. I can't
Gotcha.
speak to that.
Round up. Get your questions in real quickly. We've been on here for 45 minutes. I got to get Larry out of here. Madeline, would the asset protection be there if I set up as an individual but covered under umbrella insurance? I'm presuming.
I mean, yeah. So, and I always go to the experts. So, of course, if you talk to a attorney about this, they're going to say you can have $1 million umbrella policy, and then you have a $10 million lawsuit. So, is it really ever? You're never going to have enough insurance,
Never have
depending
enough.
on. So, like, it's always going to be hanging over your head. So, you
Mhm.
can, like I said, I'm not discouraging it. I prefer to have insurance and proper entity structure. Just knowing the world that we live in, but everyone got to take everyone has their own risk tolerance at that point.
Man, shoot. Nick's got 3 Section 8 rentals. Wants to know what is his next move. Should he transfer them into a land trust or an LLC?
Um, I mean, actually, it's because I don't, and Chris, you probably can speak on like what's the cost of getting a land trust set up.
Well, if you've got all the docs and stuff, I don't know what state he's in. You could get the docs for under $500, and then you got them. Obviously, it's the same docs, but you could use hours of $300.
We got to do
Get
an
a
annual renewal of those, like
We don't. Yeah, we just all our stuff flows right through to the beneficiary, which is my LLC. So as long as I keep my LLC, we report it. It just goes right to my LLC, man. From my perspective, a land trust is nothing but a way to take title. Period. We don't use it for anything else. Like I don't use it for any tax. It doesn't own anything but the house.
right. So I mean, to really answer Nick's question, it's I mean, there's no like best route.
No right or
Because
wrong. How you like
like I said, if you're overly concerned about someone finding out that you Nick is the owner, like I said, you're probably going to lean more into the land trust. Um,
or you
I'm
said
just
the
not sure
grant.
how easy. I know there's more issues with cracking a land trust than cracking an LLC.
Oh yeah, well, land trust is it's not really. We don't even. I don't even use them for asset protection. We just use them to hold the property. I just do. My mentor says, Chris, only reason we use grant what is it revocable living trust, same thing, revocable living
Mm-hmm.
trust, grantor revocable, they're all the same, and it's just a little different wording. Only reason we use them is because when someone wants to come after me, I want them to have a conversation with their pocketbook. All right, so that's it. If you're trying to layer all this stuff up, the trust is not for you, and if you're trying to go out there and do something shady, which we're not, I just want somebody to say, if we're gonna go after Chris, we're gonna spend some money. All right, so that way we got a bona fide suit against me.
Mm-hmm.
That's it. So LLC, our LLC is the beneficiary. It owns the trust. $10 million. Oh yeah, 1 million. J Equity. I made the mistake of buying 2 properties in my S-Corp, which I heard you should not hold properties in an S-Corp. What should I do? Operating Airbnbs, Larry. Save them, Larry.
Man,
2 properties in one S-Corp. Why shouldn't you put property in an S-Corp? I have an S election. I still have an LLC, so we don't have a corporation set up.
right. So the reason why you don't want S corps, I mean, you don't want rental properties in a S corp is a number of things. One, the purpose of the S corp is to mitigate the self-employment tax.
Oh boy.
That's the part of the S corp election. So if we're already saying that rental properties, income from rental properties is not subject to self-employment tax, you have now put something into an entity that isn't providing you any tax protection whatsoever.
Gotcha.
And it's not providing you any additional asset protection whatsoever either. So you now have moved something, especially if you use a single member LLC and did an S corp election. Now you're paying for a separate tax return for no additional benefit. And then once you start making a certain amount of money with those properties, you're now having to potentially pay yourself a salary once again for no reason because of the rental properties. Another reason why is that if you wanted to move, and this is the tough part, okay, if you wanted to move the properties out of the S corp, that's a taxable event.
What?
You can move properties in and out of LLCs with no issues. It's just a transfer. But if you're moving it out of an S corp, it's considered a sale.
That's nasty, man.
Or dissolving the asset out of the S corp. So now you're having to deal with, and that's what makes them kind of tricky from that standpoint. Then also if and I'm not sure if J Equity Group is an individual or a person or a group of people, because I have properties attached to my name through separate entities. But if I wanted to pass those properties down to one of my sons or both of our kids, they now qualify for the step up basis. And the step up basis basically means that they get the property once I pass away. They inherit the property at the fair market value of the of the date of me passing. So if I bought it for $100,000 and 50 years from now it appreciates up to $1 million, they now have $1 million asset in their hands. Once you put it into an S corp, they now no longer they don't qualify for that. So now if they do inherit it from you, they have to once again pull it out of the S corp, create a taxable event, and they're only going to get it at that book value of whatever you bought it at. So, and it's
that's deep stuff.
They operate as Airbnbs. I would need to kind of know more about the group. I'm assuming there's more than one person, which is called G Equity Group. And then what other activities they got going on with their S corp, because they may have to just rat it out, or they can, or him or they can eventually transfer it out and just deal with the tax implications in a year where they may have a lot of losses to offset their capital gain hit with. So there's some strategies to kind of help. It's just need to know more information about their situation.
Last question, then we out of here. Brandon, basically in S corp, if you pay yourself a salary, is that salary deductible?
Yes, for the business, yes. So keep in mind that, let's say to our $100,000 example, you pay yourself 30, so now your net income from the S corp is $70,000, and if you're doing it right, you should be having more deductions than that. But also keep in mind that, so let's just say it is just 30 and the 70, you'll get a 70,000 K1 from yourself, from your business. You'll also get a 30,000 W2 from your business. So you're still paying your marginal taxes based off of $100,000 of from your W-2 and your K-1. It's just that that self-employment tax is only going to be applied to that $30,000.
I
Um,
love that. So I want y'all to picture this. You can make $1 million, but you only claim, you're paying yourself 30 grand. Can you do it that big, or is that too big? I don't even. I
nah.
don't want to. Well, you can make. Well, let's just say you make 300,000. I don't know.
So I talked to different IRS agents and former IRS or colleagues who are former IRS, work with IRS. So there's no clear guidance on what's considered reasonable salary. From that standpoint, I ran through some scenarios with them based off of just ranges and percentages of net income. Could think of it like this: if you're just starting off a business, you're wearing multiple hats.
Yeah.
You're the CEO, you're the janitor, you're the IT tech, you're the admin. So it's reasonably to expect that a high should be what will be considered your salary if you're going with that S-Corp election. Now, as the business grows and the net income grows, the general thought is that you're hiring people, you're consulting, so your percentage starts to go down of your net income that's going up, but your pay still is going up because even though your percentage drops, your pay is going up because net income is going up.
Gotcha.
So I said, so there's no real clear guidance. Like I said, we try to kind of sit with our clients to kind of get an idea of like where income is at this point, where it's going to be, 3-5 year projections from there, and then because then your salary start to adjust year after year from there. But yeah, 30,000 salary on $1 million net income. Yeah, that's not gonna fly.
All right, so let's just take 300 grand, whatever, through 200,000. It's still my point is the 30. You're paying yourself not the total amount as opposed to if you have an LLC, all of it's coming in, which is just that can really hit hard, man.
Yeah, that's why self-employed individuals are really taxed the worst out of everyone, even worse than employees, because they got their tax and then the self-employment tax. That's why it's 56% of self-employment income is taxed versus 30-40%. And that's why I say how you combat that is to operate more like a larger company.
It's hard mentally though, Larry.
Yeah, it's that mental aspect of structuring yourself, like paying yourself a salary, hiring people, like starting to get stuff off of stop trying to take everything on your own, and understand you have to produce for the country. That means you have to circulate money for everyone, not just for yourself.
I always have this to myself: if you make money just for yourself, man, I think it's impossible to become wealthy. You're just making it for you. You got to make it for more people.
Yeah,
I don't see how you do it. That's how it would be done. Hey, Larry, we got an hour. We got to get on. Listen, Larry Pendleton, CPA, thank you so much for joining us, brother.
Appreciate you, Chris. Great questions, everybody.
So y'all hit that like button, subscribe to the channel, and share with anybody else who needs to understand this entity structuring stuff. And we'll see you next week on Real Estate Tax Talk. Thanks, Larry.
Appreciate it.
All right, peace.